Capital gains tax on real estate is the tax you pay when you sell a property for more than you paid for it. The government taxes the profit, not the total sale price. Understanding how it works can help you save money and plan smarter when buying and selling real estate. Let's break it down. When you sell a property, the capital gain is the difference between the purchase price, also called the cost basis, and the selling price. For example, if you buy a home for $200,000 and later sell it for $300,000, your capital gain is $100,000. This is the amount the government taxes. Capital gains tax comes in two types, short-term and long-term. If you sell the property within 1 year of buying it, the profit is taxed as short-term capital gains, which is taxed at regular income tax rates. This can be as high as 37%, depending on your income. If you hold the property for more than 1 year, it's taxed as long-term capital gains, which has lower tax rates, typically 0%, 15%, or 20%, depending on your income level. There are several ways to reduce or avoid capital gains tax on real estate. One of the most common is the primary residence exclusion. If you've lived in the home for at least 2 out of the last 5 years, you may qualify to exclude up to $250,000 of gains if you're single, or $500,000 if married. This means if your profit is below these limits, you won't owe any capital gains tax. Another way to avoid capital gains tax is through a 1031 exchange. This allows real estate investors to defer paying taxes by reinvesting the profits into another investment property of equal or greater value. This strategy helps investors grow wealth without paying immediate taxes. Let's say you buy a rental property for $150,000 and sell it 5 years later for $250,000. Your profit is $100,000. Since you held the property for more than a year, it's a long-term capital gain. If your tax rate is 15%, you'd owe $15,000 in capital gains tax. However, if you used a 1031 exchange to buy another investment property, you could postpone paying taxes altogether. Capital gains tax on real estate depends on how long you own the property, how much you profit, and whether you qualify for exemptions. Knowing the rules can help you minimize taxes and maximize profits when selling a home or investment property. Now you know how capital gains tax on real estate works.